$500 a month for 20 years, the difference between doing it right and doing it wrong isn't a few $1,000s. It can be the difference between retiring at 50 and still working at 70. Here's the strange part. None of that gap comes from picking the next Apple. None of it comes from being a stock market genius. It comes down to 7 mistakes almost every beginner makes, usually without realizing it. And the scary part is, most people don't discover these mistakes until they've already lost years of wealth. Warren Buffett once said, the stock market is a device for transferring money from the impatient to the patient. But patience alone isn't enough, because you can be patient and still make decisions that quietly destroy your future wealth. Over the next few minutes, I'm going to show you the 7 investing mistakes that silently keep millions of people from becoming wealthy. Not with complicated financial jargon, but with simple stories. The same way an experienced investor would explain them to a friend sitting across the table. Because once you see these mistakes, you'll never look at investing the same way again. And the first mistake is probably one you're making right now without even knowing it. Chapter 1. Waiting until you know enough to start investing. Here's the first mistake, and it's probably the most expensive mistake on this entire list. Not because it loses you money overnight, but because it steals the one thing Warren Buffett says is impossible to replace: time. Most beginners don't say, "I'm never going to invest." They say something that sounds much smarter. "I'll start once I understand the market better." Maybe after reading one more book, or waiting until the economy feels safer. It sounds responsible. But here's the problem. The market doesn't reward people who know everything. It rewards people who start learning while they're already in the game. Picture standing at the edge of a swimming pool, reading about technique for months, while your feet never touch the water. Now picture skipping straight to the lesson, jumping into the shallow end, making mistakes, improving a little every week. 5 years later, which version of you is the better swimmer? The answer is obvious. Investing works exactly the same way. Most people think knowledge creates confidence. In reality, action creates confidence. Warren Buffett didn't become one of the greatest investors because he knew everything before buying his first stock. He became great because he spent decades learning while investing. Every mistake taught him something. Every year gave him experience that no book could ever provide. That's why Buffett once said, "The best investment you can make is in yourself." Notice what he didn't say. He didn't say, "The best investment is waiting until you're perfect," because perfection doesn't exist. Say you start today with $300 a month in a low-cost index fund. Nothing exciting, nothing flashy. Now, say instead you spend the next 10 years trying to become the perfect investor first. Reading, watching predictions, waiting for the right moment before finally starting at 35. By then, you'll feel smarter, more prepared. But you'll have one massive problem. The version of you that started at 25 has something you'll never get back: 10 extra years of compounding. And that's the cruel part. The market can forgive bad timing, but it never gives you back lost time. This is where beginners often misunderstand Warren Buffett. People think his greatest advantage was finding incredible companies. It wasn't. His biggest advantage was that he started incredibly young. Buffett bought his first stock when he was just 11 years old. Years later, he even joked, "I was wasting my time before then." Think about that. One of the richest investors in history looked back and wished he had started even earlier. Not because he needed more knowledge, but because he understood something most people don't. Time is the asset. Money is just the fuel. Every year you delay, you're asking your future self to work harder for the exact same result. Once you truly understand that, the real question stops being, when is the perfect time to invest? It becomes, how much time am I losing by waiting? But starting early alone isn't enough, because thousands of beginners actually do start investing, then immediately make the second mistake, a mistake that turns investing into gambling. And that is where most people begin losing money. Chapter 2. Treating the stock market like a casino. Here's a mistake that has quietly emptied more investment accounts than almost anything else. Treating the stock market like a casino. Imagine walking into a casino with $10,000, lights flashing, people cheering, someone just hit the jackpot. Suddenly, you stop thinking logically. You just want to win. That same feeling pulls millions of beginners away from investing and into gambling. Except, nobody calls it gambling. They call it an opportunity. One week it's AI, the next it's crypto, then it's the hottest EV company. Suddenly, everyone is talking about a stock that's guaranteed to double. Without asking a single question, people buy it. Not because they understand the business, but because they're afraid of missing out. That's not investing. That's gambling with better marketing. Warren Buffett has spent decades warning investors about this. Because when you buy a stock, you're not buying a lottery ticket. You're buying a small piece of a real business. Think about it. If someone offered to sell you a neighborhood coffee shop, would your first question be, how much can I sell it for next week? Of course not. You'd ask, is the business profitable? Do customers keep coming back? Will people still buy coffee 5 years from now? Those are the questions an owner asks. So why do those questions disappear the moment a business is listed on the stock market? Because the market turns businesses into numbers, a green arrow, a red arrow, a percentage gain, a percentage loss. Slowly, people stop thinking like owners and start thinking like traders. Warren Buffett never made that mistake. When he invested in Coca-Cola, he wasn't thinking about next month's stock price. He was thinking about something much simpler. Millions of people buy Coke every single day. That habit had existed for decades, and he believed it would continue for decades more. That is investing. You're betting on a business, not a headline. Now compare that with buying a stock because someone on social media posted rocket emojis. One decision is built on understanding. The other is built on emotion. And emotion is expensive. History proves it. The dot-com bubble, the housing bubble, meme stocks. Different decade, same psychology. People stop asking, is this a great business? And start asking, how fast can this make me rich? That's the question that destroys portfolios. Because investing was never designed to make you rich overnight. It was designed to make you rich over time. Warren Buffett once said, the stock market is a device for transferring money from the impatient to the patient. Most people think that quote is about waiting. It isn't. It's about controlling your emotions. Every panic sale, every hype purchase, every emotional trade quietly steals a piece of your future wealth. The greatest investors don't succeed because they predict the future. They succeed because they refuse to let emotions make their decisions. And that brings us to the next mistake, one that doesn't feel dangerous at all, until one day you realize you gave up just before investing was finally about to reward your patience. Chapter 3. Giving up because compounding feels too slow. Here's the problem with compounding. It doesn't feel powerful until suddenly it becomes impossible to ignore. And that's exactly why so many beginners quit too early. Imagine pushing a giant snowball down a snowy hill. At first, it barely moves. You keep pushing. Still small, still slow, still unimpressive. If you stopped there, you'd probably think, this isn't worth the effort. But keep going. The snowball gets bigger. Now it collects more snow with every turn. Soon, it's moving faster than you can keep up. Eventually, it's so large you couldn't stop it even if you tried. That's exactly how compounding works. The biggest mistake beginners make is judging it too early. They invest for 6 months, maybe a year. Their portfolio moves up a little, down a little, sideways for a while, and they think, that's it? I expected more. So they quit without realizing they walked away just before compounding was about to do the heavy lifting. Nobody understood this better than Warren Buffett. People assume he became wealthy because he found incredible investments. But here's a fact that surprises almost everyone. Most of Buffett's fortune was built after the age of 60. Not because he suddenly became smarter, not because he discovered a secret strategy, because compounding had been quietly working for decades. For years, the results looked ordinary. Then, time did what it always does. It multiplied everything. Every dollar you invest has 2 jobs. First, it earns money. Then, that new money starts earning money of its own. Eventually, your investments begin working harder than you do. That's the point everyone dreams about, but very few people stay invested long enough to experience it. Why? Because our brains love immediate rewards. Fast results feel exciting. Slow progress feels disappointing. But wealth has never rewarded excitement. It rewards consistency. Warren Buffett once compared investing to rolling a snowball down a long hill. Notice what matters most, not just the snowball, the length of the hill. Every year you stay invested, the hill gets longer. Every emotional decision cuts it shorter. Today, that's harder than ever. Every headline tells you someone got rich overnight. Social media celebrates quick wins. Suddenly, your slow-growing portfolio feels like it's falling behind. But remember this, a tree doesn't grow faster because you check it every day, and your investments don't compound faster because you refresh your portfolio every morning. The market rewards patience, not constant attention. And that leads to the next mistake, one that convinces perfectly intelligent people to stop trusting their own judgment and start following everyone else. Chapter 4. Following the crowd instead of thinking for yourself. Imagine you're walking through a shopping mall. One restaurant is almost empty. The one next to it has a line out the door. Without knowing anything about the food, your brain immediately thinks, that one must be better. That's human nature. We assume if everyone is doing something, it must be the right choice. In everyday life, that instinct often helps us. In investing, it can quietly destroy your wealth. Because by the time the crowd arrives, the biggest opportunity is usually already gone. Look at every major investing craze: the dot-com bubble, the housing boom, meme stocks, crypto, AI. Different markets, same psychology. At first, only a few people believe. Prices begin to rise, the media starts talking, friends start making money, social media explodes. Then, suddenly, everyone wants in. Not because they understand the business, but because they don't want to be left behind. That's FOMO, fear of missing out, and it has cost investors billions of dollars. Warren Buffett built his career by doing something most people find incredibly difficult: ignoring the crowd. While others watched headlines, he read annual reports. While others chased trends, he studied businesses. While others reacted emotionally, he stayed patient. That's why Buffett said, "Be fearful when others are greedy, and greedy when others are fearful." Most people misunderstand that quote. It doesn't mean always doing the opposite of everyone else. It means don't let the crowd make your decisions. Imagine buying a house. Nothing about the neighborhood changes. The schools are the same, the parks are the same, the houses are the same. Then, suddenly, everyone wants to live there. Prices double. Did the neighborhood really become twice as valuable overnight? Probably not. Only people's emotions changed. The stock market behaves the same way. Sometimes prices rise because a business becomes stronger. Other times they rise because people become more excited. Those are two very different things. Buffett never tried to predict what the crowd would do next. Instead, he asked better questions. Is the business gaining customers? Is it earning more money? Does it have an advantage competitors can't easily copy? Will people still need its products 10 years from now? Those questions aren't exciting, but they build extraordinary investors. The uncomfortable truth is, the best investing decisions usually feel uncomfortable when you make them. Buying when everyone else is afraid feels scary. Ignoring the hottest trend feels like you're missing out. Holding while everyone else is selling feels lonely. But the market has never rewarded people for following the loudest voice in the room. It rewards people who think independently. Because in the end, being different doesn't make you money. Being right does. And that brings us to another mistake, one that causes intelligent people to invest in businesses they don't actually understand. Chapter 5. Buying businesses you don't actually understand. Imagine someone tells you, "I've found the next big investment. The technology is revolutionary. Everyone's buying it." Then you ask one simple question: how does the business actually make money? And they answer, Honestly, I'm not sure. Would you invest? Probably not. Yet millions of people do exactly that every year. They buy stocks they don't understand, not because they studied the business, but because they heard a convincing story. One company mentions AI, another talks about blockchain. Someone says it's the next Apple. And suddenly, people start investing in businesses they couldn't explain to a 10-year-old. Warren Buffett has avoided this mistake for decades. One of his simplest rules is also one of his most valuable. Stay inside your circle of competence. You don't need to understand every business. You only need to understand the ones you choose to own. Imagine buying a small hardware store in your town. Before investing your money, you'd want answers. Does it make consistent profits? Why do customers keep coming back? Will it still matter 5 or 10 years from now? Shouldn't you ask those exact same questions before buying a public company? Most beginners don't. Instead, they ask, how high can this stock go? Notice the difference. One question is about a business, the other is about speculation. For years, Buffett criticized him for avoiding many technology companies, not because he disliked technology, but because he refused to invest in businesses he couldn't confidently understand. Then he did something that surprised everyone. He invested billions in Apple, not because it was a tech company, but because he finally understood the business. He saw loyal customers, a trusted brand, consistent profits, and millions of people buying iPhones again and again. To Buffett, Apple wasn't just selling technology, it was selling trust, habit, and an ecosystem customers didn't want to leave. That's very different from buying a stock simply because someone online calls it the next Apple. One decision is built on understanding, the other is built on hope, and hope has never been an investment strategy. Here's a simple question Buffett would probably ask before buying any company. If the stock market closed tomorrow and didn't reopen for the next 10 years, would you still be happy owning this business? If that question makes you uncomfortable, you probably don't understand what you own. Because when you truly understand a business, daily price movements become far less important. You stop watching the chart and start watching what actually creates value: customers, profits, competitive advantage, and long-term growth. Because in the end, stock prices follow businesses, not the other way around. And even when you own a great business, one small habit can still ruin everything. A habit almost every beginner believes is harmless: checking their portfolio every single day. Imagine buying your dream house, great neighborhood, excellent schools, perfect for your family. Now imagine someone knocks on your door every morning. On Monday, they offer you $520,000. Tuesday, only $495,000. Wednesday, $535,000. Would you suddenly believe your house became a bad investment on Tuesday and a great one again on Wednesday? Of course not. Nothing about the house changed, only someone's opinion of its price did. Yet millions of investors do exactly that every single day. They open their investing app, see one red number, and immediately question every decision they've made. Here's the truth. The more often you check your portfolio, the harder it becomes to think like a long-term investor. Because eventually you stop owning businesses, you start managing emotions. Warren Buffett has never built his fortune by watching stock prices all day. He focused on understanding businesses. Because stock prices change every second. Great